Welcome, Anand, on this Dawdle.live show, and extremely happy that you're building something, fabulous. So we are a community of over 180,000 plus senior leaders from across the globe. A lot of them are working in very big companies as well. So this will also give them an opportunity to evaluate investment opportunities or advisory opportunities with your startup. Besides, we will also streamline any business related conversations as well, because this will also help us push the business to them as well. So welcome you and thank you so much for joining us. So maybe we can start with a quick 10 minutes kind of an introduction about your startup and then we go to Q&A.
Sure, Mr. Rishikesh. Thank you. Thank you for this opportunity. And it's a pleasure being on this platform. Let me just explain you about the company and what work we currently do. Electric is an EV mobility company. We have built this company over last 4.5 years. As we speak, we are at the end of the fourth fiscal year. We have completed 4 financial years, plus
Hmm.
couple of months of initial company setup. We have been a private limited company from day one with all the statutory compliances and certifications that are required. We also have built our own digital platform so that our consumers can connect with our business through a consumer centric app, which is available on Play Store. Plus, we have an internal team, all the employees work on an internal
Hmm.
platform, or you can say an internal app that we have end to end for all employees to conduct their operations. Plus, we also are currently building a CKD assembly, which is almost ready as we speak. It will be operational in next week's time. We are waiting for the raw material to reach. So, if I have to sum it up, we are an EV mobility company. We have our own business, whether it is customers or internal employees or the entire ecosystem. Number two. Number three, since we are in the EV two-wheeler space currently, so we control the business or have a control on the product. We also have set up as in-house CKD assembly facility where we will build our own EV two-wheelers. This is how we work right now. In terms of our business model, we provide EV two-wheelers to the gig workers, especially those people who work as delivery boys,
Hmm.
providing delivery services, whether it is quick commerce, e-commerce, or you can say courier or food grocery across various platforms. So
Hmm.
what we do is that we have our own fleet of 1,100 vehicles. We provide these vehicles on an affordable rental facility to these riders. And it is a pay and use model where the riders have to pay the weekly rent in advance along with a nominal security deposit, then use the product for a week. And after the week, either they can return the product or they can continue with the product. Because these riders use this product for
Hmm.
their livelihood purpose, which means that without this product, they may not be able to work on the delivery platforms or on the e-commerce platforms.
Hmm.
So we also ensure that, and also that these people get financial inclusion system, which means that they may or they may not get loans to procure a two-wheeler by themselves. So
Hmm.
they, and unless they don't have a two-wheeler, they will struggle with the livelihood. So here the product performance, product quality, product support in terms of service, maintenance, any breakdowns that can happen, and the product life cycle plays
Hmm.
a very important role. If you look at any quick commerce, e-commerce, food delivery, which operate within the intra-city space,
Hmm.
here two things are essential. One is the person who will do the delivery from point A to point B in the last mile delivery space,
Hmm.
and second is the vehicle. So these delivery platforms are giving an opportunity to work for the people to work. Then the second important aspect is the vehicle, which they don't provide. So that is where we come in the play. We
Hmm.
provide the vehicle as a capable rental. We give a product and service guarantee. That means any issues with the product, any issues with the service, any manufacturing defect, any maintenance defect is taken care free of cost. We don't
Hmm.
charge anything to the rider. We also provide breakdown assistance in the cities that we operate us. So any complaint or any feedback received during the day between 9 a.m. to 5 p.m., the problem is resolved on the same day within 4 to 5 hours. So we have built an ecosystem of product guarantees, service guarantee, service stat of 4 to 5 hours, and all this works seamlessly through our digital platform. Now, in terms of our business GTM, we work like an hub and spoke. So currently, we are based in Hyderabad. We have operations in Hyderabad, Bangalore, Chennai, and Coimbatore. So we call these cities like Hyderabad, Bangalore, and Chennai as hubs. And under these hubs, we are building a spoke. Spoke means smaller outlets which are closer to the consumer. And through this entire ecosystem, we provide mobility as a service, that is vehicle rentals. Number one. Number two, we provide battery leasing oblique battery swapping, which means that any rider who wants to have an additional battery, if he wants to travel longer, we give him an additional battery. But predominantly now the focus is on battery swapping, where we give unlimited swaps per day. So a rider can come to us, take a vehicle, avail the battery swapping, and if the battery gets exhausted, he can just come back, return the battery, and take a fully charged battery. No extra charges except for the rent that we charge for the week or for the that's how we operate. So we are trying to be as closer and as consumer centric as possible while we also generate our revenues. So our revenues come from vehicle rental or mobility as a service. They come from battery leasing or rental. Battery swapping is integrated in mobility as a service model. Our revenue comes from service and spare parts wherever the mandatory or other parts are consumed. At a small level, we also started providing manpower services to these platforms. So there are people who come to us looking for job opportunities. So we provide them along with the vehicle to these platforms. And now that we are building this model, so we call it as a COCO, company owned, company operated model. Then all the outlets are owned by us and operated by our own team. Going forward in FY27, we are going to add a second layer of franchisee, that is a franchisee owned and company operated, where we will go reach out to the franchisees, ask them to invest in this model, and we will support them in the operations because all our front end and back end is integrated and taken care. So it's like a plug and play for a franchisee. He just has to come on board, make an investment, and then all the operations are taken care. And by FY28, we will we'll add the third layer of franchisee, which is a franchisee owned and franchisee operated model where everything will be decentralized to a franchisee and he will conduct the operations exactly the way we are doing it. And in the stages of our franchisee expansion, we will also start selling of the vehicles through our own outlets, which means we are not currently planning to go aggressive on sale of the vehicles. Our business model primarily still revolves around vehicles on rent and not as selling of the vehicles. But selling of the vehicles will happen because in the geography where we operate, there is a density of vehicle population which people see and people who want to have a EV vehicle. I think for them it becomes a good opportunity that they can use our product. So that's how we are building our revenue and business model going forward. All 4 years we have been PAT break-even. We have never burned since inception and cumulatively as well. All that, and we have been bootstrapped. So all that work that we have done, it is by our. Definitely, we have been able to sustain the business on a PAT break-even basis. Though the margins are very thin, the PAT margins are very thin. We work at a gross margins of 40% currently, where we consider that the asset is as a debt, not as a equity component. If in case we raise sustainable certain amount of money in line with our plans, then our gross margins can go up to 50-55%. That is one part. Number two, our current EBITDAs last year, FY25, we closed the EBITDA at 9%. This year, our EBITDA is expected to be somewhere between 10 to 12%. Last year, our PAT was close to 1%. This year, we're expecting slight improvement, not much of the improvement. FY27, we are targeting a revenue of between 10 to 12 crores. And for that, we already have started procuring your next 1,000 vehicles fleet expansion that we plan to do. So today we have 1,100 vehicles. We want to add another 1,000 vehicles. So the components required to make the finished goods are already in transit and in line with our plan, we expect to deploy these 1,000 vehicles anywhere between March and June during the next 4 months. And if we are able to successfully execute this deployment in 4 months, our revenues would increase anywhere between 1.6 to 1.7x from the current level, which means that FY25 we closed at 4.8 crore. FY26, that is this fiscal year, we are estimated to close the top line at around 5.2 crore. Next year, we are targeting a top line of around 10 to 12 CR. And to make that happen, the second tranche of 1,000 vehicles are, and the fundraising that now we are planning to undertake of anywhere between 3 crores to 5 crores. If we are able to successfully raise the funds in next couple of weeks, the faster we raise the funds, we would be deploying another 1,000 vehicles. So if we are able to deploy 2,000 more vehicles in FY27, we are pretty confident that our top line should go beyond 10 crores or 10 to 12 crores, and our EBITDA numbers should be around 12-13%, and our PAT numbers should come closer at least to 2% from the level of 1%. So while we want to grow, adding a fleet expansion, being a franchisee expansion, we are also very clear that our business has to be EBITDA positive in the range of between 12 to 15%, and it also has to be PAT positive in the range of 2 to 5% by FY27. And in FY28, we are targeting a top line of anywhere closer to 100 crores. 49 crores, and then 100 crores in the subsequent year. So that while our top line also grows, our bottom lines also should healthier and stronger, so that we have a free cash flow available in the system and not just dependent upon the fundraise to scale and survive the company. This is in the nutshell how.
Got it. So, Anand, the first question that we have is from Rajesh. So, Rajesh is based out in Malaysia,
Sure.
and he has been a part of a couple of big tech companies. Uh, he has already invested in 4 startups. And so his question is that, your EBITDA per vehicle over 3 years is 8,000 to 20,000, which translates to roughly 8 to 10% life cycle EBITDA margin. How will this improve meaningfully as you scale, and what specific levers exist to increase per vehicle profitability?
See, I'll explain you the unit economics that will make you easier to understand and answer this question specifically. See, today what is happening is that when we plan our EBITDA numbers, like I'm saying 9% or 12%, considering that if the asset cost is say 85,000 rupees, and assuming that this entire 85,000 rupees I'm taking as a debt
Right.
component where I have to pay back the principal, and if I deploy the same vehicle towards, and I don't have to pay any debt to anybody, I just have to apportion the principal amount as repayment, then I save 30% of the interest outflow. So my gross margins can clearly go by another 15% from my current level of 40%. So that directly will have an
Yeah.
impact on my EBITDA numbers, which are around 9-10%, going up as high as 14 to 15%. So that is one way we can increase our
Mm.
EBITDA numbers. Till now, we were not doing in-house manufacturing. Now that we have got into our in-house manufacturing, here again we have built in a margin of around 15% to 20%. So on a net basis, the entire gross margin may not be 15 to 20%. It may translate into 10% for us. So that 10%, when it adds up, it also directly benefits our bottom line in terms of increase in EBITDA. So one is, see, when you can start controlling your product and when you have everything in-house, it increases your margins, number one. Number two, when you are able to raise cheaper money or money through equity, then you don't have to pay your interest back. That increases your gross margin EBITDA. That is number two. Number three, as your denominator increases, suppose today, like I said, I have fleet of 1,100, then so when I move from 1,100 to 2,000 to 3,000 vehicles, the revenue will increase, say, 70%, 1.7x or 1.6x or 1.8x on every 1,000 vehicles I add. But my cost is not going to increase at that level. My cost may increase by 20% or 30%. So there will be a per unit increase or margin increase that's going to happen. And see, the way we are operating since last 4 years, we consider every hub has to be a profit center. So if I'm operating X number of vehicles in a particular city, I have to make sure that the entire operations of that particular city are profitable, and I'm able to plow back some excess money into my central office so that my central team cost is also recovered. So this is how we have structured our business model, and that's how we have, see, being a bootstrap, I think we are one of the very few companies in this space, especially the mobility space, both in the retail side and the commercial side, who are able to get EBITDA positive and PAT break-even number. So I think we have proved to a larger extent, demonstrated a POC, if you can call it so, in last 4 years, that this business is scalable, sustainable, and as well as profitable.
Got it. I've got a question from Jeff. So he kind of joins us from the US, and he kind of heads business for a big IT services company there. And the question is that since this is an asset heavy model requiring upfront vehicle capex, what is your capital required per vehicle deployed, and what is the IRR per vehicle across its life cycle?
Yeah. So again, it's the same question, similar question. See, my per vehicle product cost is 85,000 rupees. Okay. So when I say 85,000 rupees, 85,000 rupees includes the product cost, it includes the insurance, it includes the IoT, and it includes the management cost of 3 years. My if I have to give you my ROI in terms of gross margin, it is around 40 to 55%. If I tell you my ROI in terms of EBITDA, which is 9% today, 1,100 vehicles, when I put another 2,000 vehicles, it's going to go around 14-15%. I'm already doing in-house CKD assembly. I'm already doing in-house battery swapping, and the another revenue vertical, which is selling of the vehicles, where my working capital cycle rotation will be 70 days to 90 days. Today, my working capital cycle on a vehicle is 36 months. But when I sell even a small component of my fleet, say today out of 3,000 vehicles, I earmark only 500 vehicles for retail purpose. I can rotate this in 70 days cycle, where the gross margin there will be less than the rental business, but there my capital availability will be every 70 days. So that will also bringing me revenue. That will also increase my top line. That will also help me increase my bottom line, because I'm not going to invest on infrastructure when I'm going to sell my vehicles. I'm already building my stores, my spokes. So everything is going to happen under single roof.
Now, I've got a question from Avinash. He heads business for a delivery company in India. So there are competitors like Zypp, Yulu, and Hala who already have fleets of 5,000 to 20,000 vehicles and are well funded. So what is your durable competitive advantage that prevents them from replicating your model and outcompeting you on pricing or fleet scale?
Okay, before I answer the specific point, if you look at all these people, if they are very well funded, if the business model is proven, then why they are EBITDA negative for all 8 years or 9 years from the day they started the business? Zypp raised 80 million, Yulu raised 120 million, and Hala raised between 5 to 7 million. Recently, they have raised some money in Bharat Ke Super Founders also, right? Now, they're all earlier than me, number one. Number two, they're all, number three, at a revenue of 400 crores of Zypp, then why they have a fleet of only 25,000 vehicles? That means they should have a bigger fleet. Na? So the number of vehicles, their uptime versus downtime, and the revenue numbers don't match mathematically. I mean, you can do your maths. If my unit economics per vehicle as a rental is 5,400, even Zypp unit economics should be 5,400. So at 5,400, if you have a fleet of 20,000 vehicles, just imagine the amount of money that you're generating per month. So there's somewhere a problem in the business. That is number two. Number three, see, like I said, my business revenue depends upon product. It doesn't depend upon my digital platform. My digital platform helps me improve my efficiency and business. Right. But I don't generate revenue. I don't sell my database. I don't do any marketing activities. I generate revenue core from my vehicle. That is number two. So in case of Zypp, Zypp buys vehicles from 5, 6, 7 different operators. Hala buys similarly. Only Yulu takes vehicles from Bajaj, which is their single source. But the Yulu product is not mobility, it is a micro mobility product. The speed is restricted, size is restricted, product type is restricted. Now, when I compare myself with Zypp, if you look at Zypp business model runs on manpower services more than vehicle rental. That means they prefer getting a rider to work through them on these platforms, so that the salary of the rider is diverted through their app to the rider, and they earn on that 7, 10, 12, 15% commission which this platform pays. So for them, vehicle rental is not a direct or a full-fledged revenue. My business model is completely on generating revenue through the product, number one, battery swapping as a support system, number two. Number three is getting into a retail business. And why I can do retail, why they cannot do retail like me, is because I run my own infrastructure. I build my own vehicle. I don't procure vehicle from multiple players across the board to. So I manage my complete product ecosystem 100% in-house. That is where I burn, or I don't, I spend less money as compared to my competitors. Now, all these companies are piggybacking their model on the similar target audience, but their approach to the target audience is completely different than what
Got it.
we
Now,
do.
so Pawan
Yeah.
joins us, and okay, so Pawan is telling that he has handled for his company the COCO to FOCO and FOFO models. So he wants to ask that what operational systems, brand strength, and partner economics will ensure franchisee partners will invest and maintain service quality at
See,
scale?
like I said, right now we don't have a franchising. Number one, we are doing a COCO
Mm,
model, which has a positive break even. Number one, when we are going to the
mm,
franchisee model, we are talking about franchisee on company operated. In this model, we are asking the franchisee to invest on infrastructure and vehicles, whereas we have our own digital
mm,
platform which we will give it to him, and it will be revenue sharing. So the majority of the revenue will go to the franchisee because the investment they have done, and the minority revenue will we are running the operations on behalf of that franchisee. And to make sure that the franchisee is profitable, that is why I am running a multiple revenue model from that outlet. So in a location where I am going to appoint a franchisee, then my outlets will not be operational in those locations, so that the entire
mm,
geographical business opportunity goes to the franchisee. And we will try to ensure
mm,
that the kind of EBITDA numbers that we are getting, the franchisee should get similar or better numbers than what. So that is how we are going to build a franchisee model. When we go complete franchisee, that is franchisee on franchisee operated, he will not only generate revenue from rental business, but he will also generate revenue from selling of the vehicles also. So there will be two
mm,
or three verticals of revenue opportunities that we will give to franchisee. Only then we will move to the complete franchisee model. We don't want our franchisee to lose money because franchisee is going to be like an investor for us. So if my investor loses money, then it will have a
mm.
direct repercussion in the market. If my franchisee closes down for whatever reason, if he's not making money and not happy with my services, then my brand image, my
Mm.
customer serviceability level.
It. I must say, Michael Farmer has also joined us. So he is a partner at Bain Consulting, and he's based out in London. So must say that he knows a lot about the Indian ecosystem, because the question is like, what percentage of your revenue depends on top B2B customers? And what happens if one major platform, say Swiggy or Zomato, reduces EV fleet demand or builds in-house
Okay.
capabilities?
So let me answer this. When we started 4 years back for B2B, that is the revenue via these platforms, that is Swiggy or Zomato or Zepto was 100%. And our revenue from direct riders was 0%. Number two, there's not just only Swiggy or Zomato. There is Swiggy, Zomato, Zepto, Amazon, Big Basket, Delivery. I mean, there are a whole lot of top 7, 8, 9 brands. Then there are smaller brands and smaller fleet operators who cater to this market, because this market today is like 2 million gig workers who use delivery, and the penetration is only 10%. So whether
Hmm,
I am there or like me, four more, five more people are there, bigger or smaller than me, till the time the penetration reaches 40% or beyond 40% or a saturation level, the space is enough for everybody. Because in 2 million,
hmm,
if I'm talking about 40%, we're talking about 800,000 vehicles. Where is the money to
hmm,
put in 800,000 vehicles? Where are that many companies who can put that many vehicles, manage those vehicles for a 3 to 4 year life cycle? It's not easy. If you are
right,
only depending on investor money to manage, the companies will go burst in 3 to 4 years. That is number two.
right.
Number three, now coming to specific revenue model. Today, my revenue
Hmm,
from B2C, that is a writer who comes to me directly. He may work with
hmm,
Swiggy or Zomato or Zepto. That is his choice. But I collect the money
hmm,
directly from him, as a pay and use model is 75%. And my revenue
hmm,
from the B2B platforms like delivery, oblique Swiggy, oblique Zomato, with whom I have agreement, is 25%. So what we have done is that risk mitigation of revenue distribution along
hmm,
multiple models is what we are ensuring. The B2C customer gives me pay and use. That means I get cash every day. So my cash flow is healthier. In B2B, I get a visibility, awareness to a larger audience, but my cash flow gets suffered because I have to offer a 45-day credit line. Now, to the last point,
uh,
saying that what happens if Swiggy stops EV, I don't think Swiggy or anybody will stop EV for two reasons. One, because they have submitted
hmm,
a declaration to all the stock exchanges that by 2030 and 2035, their entire fleet will be
hmm,
EV. That is there. So they can violate that. I am nobody to judge that point. Number one. Number two,
hmm,
the people who use EV vehicles versus petrol vehicle. To run a petrol vehicle
hmm,
in a month will cost a fuel cost of 5,000 to 6,000 rupees. Plus, he has to own a vehicle by himself. Plus, he has to maintain the vehicle, pay for the insurance of the vehicle, and use it or abuse the vehicle. In my case, in just
hmm,
5,900 rupees, I am giving him vehicle, free service, free
hmm,
breakdown, IoT tracking, insurance, and no investment on the vehicle. So logically, anybody who is working in the commercial space, any commercial space, if not personal use, it is advisable that he move to any EV vehicle that is available, so that whatever he's spending on the fuel is equal to the lease cost of the vehicle. Plus, he saves on the investment, asset cost, and various other things. So, I think these two logics should be good enough for the people working in the commercial space to move from non EV to EV. Pollution, nobody talks, but petrol vehicles contribute to 26% of total pollutions in India, which is called tailpipe emissions. And this data, again, you can check with any of the Niti Aayog report, which is the largest
Right.
concentration of pollution in urban markets. So I think if this happens 30, 40, 50% penetration, even in next 5, 6 years, in the amount of pollution levels or the temperature levels will come down drastically.
So, sir has got another question is that do you also plan to, go beyond India and offer these services to
So,
adjacent
see, I
countries
come
as well?
from an auto two-wheeler background. Spent 20, this is my
Mm.
28th year in the auto industry in India. I have been with corporates like Piaggio, Suzuki, Yamaha, yes. Worked in India and South Asia. Expanded business for these brands outside India and South Asia. We have connects in African continent, in Central Africa, East
Mm.
Africa. We have our connections to Sri Lanka and other neighboring countries. So we have an
Mm.
foresight that one of the reasons why we have put a CKD assembly unit is not just to sell vehicles in India. Going forward in
Uh,
phase two of a manufacturing infrastructure expansion, we are going to get into component level assembly in India. So vehicle assembly, then go a step forward to component assembly. Then third step would be setting up business operations or expansion towards African market or the GCC market, because African market also is struggling in terms or having a conversion boost from non-EV to EV. And these markets follow Indian market. They are currently maybe 5, 7 years behind the Indian industry. So these are the markets where we have a target. But then see, today I don't have money to put expand fleet in India. So at this stage, if you ask me today in this first year, am I going to start exports? I may not be doing that. But in FY 27, 28, I may be doing, yes, I'll definitely look at sending vehicles to these countries through our network.
Got it. I don't know how to pronounce this name. Please forgive me if I tell wrong. It's Chong Louis. He's joining in from Hong Kong. She has a question that what is your rider churn rate, vehicle utilization rate, and payment default rate? And how do these metrics change across cities and
See,
rider
we are not
segments?
full-fledged into rider hiring. So, but I'll give you the rider churn rate or the rider attrition rate from a platform perspective. It is between 25 to 35%. That means on a daily basis or a weekly or a monthly basis, there is an outflow and inflow of 25% to 35% of the people working in the delivery platform. Number one. Number two, the why the reason is that because anybody who is using a two-wheeler to ride 80 to 120 kilometers physically and
Hmm.
medically, if he uses does this job for a longer period of 2 years or 3 years, it can hamper their health, plus the pollution and other aspects. That is number one. Number two, in terms of vehicle utilization, our out of 1100 fleet, all the vehicles which are 3.5 years and above in our fleet have a uptime of 40% and a downtime of 60%.
Nice.
All the vehicles that are in our fleet, which are 2 years or less than 2 years, 2 years to 1 year, have an uptime of 85%. And all the vehicles which are less than 1 year old have an uptime of 90%. Cumulatively, today, my fleet uptime out of 1100 vehicles is anywhere between 65% to 70%.
Got it. Now, one of the questions from our side is that, what specific milestone will take the company from 1,100 vehicles to 25,000 vehicles? And what does revenue, EBITDA, and valuation look like at that scale?
See, our target is to have a fleet size of 25,000 vehicles in third or fourth year from now. So if I
Mm.
would tell you our FY 27 target is to have fleet of 3,000 vehicles, then add
Mm.
1,000 more, 10,000 more vehicles in FY 28. And by that time, we'll
Mm.
have a cumulative fleet of 14, 15,000 vehicles and another 10,000 plus vehicles in FY 29 so that we have a cumulative fleet of more than. Now to do this, we have to do following.
Mm.
Number one, we have to spread our hub and spoke model. See, today we are there in 4 cities, but only with a very
Mm.
limited presence. That means I just have two spokes and one hub in Hyderabad, one hub in Bangalore, and one hub in Chennai, which is not good enough to cover the entire city. Number three, in terms
Mm.
of potential per city, where I'm saying that there are 200,000 vehicles of EV in the delivery space. But if you look at per city potential, every city has a capability to have anywhere between 10,000 to 20,000 vehicles in delivery space from an
Yeah.
EV perspective. So
Mm.
if I have to do 25,000 numbers, then I have to be present in at least in 8 or 10 cities. I need to have my network of anywhere between 60 to 80 outlets, so that per outlet does around 200 to 50 or 300 vehicles. If I'm able to build this kind of a network, whether it is a COCO model or a FOCO model or a complete franchisee model, point is have 65 to 80 outlets. Be there in 8 to 10 cities geographically where you have a wider presence and you have a depth of presence. Number three, to support this kind of a fleet, your manufacturing infrastructure or the component ecosystem also has to be strong, because these vehicles will travel 80 to 120 kilometers per day. So you can imagine that in 3 years, these vehicles should be doing 80,000 kilometers to 100,000 kilometers by fourth year. So the kind of back-end infrastructure support and digital footprint expansion also needs to happen parallelly. See, today we have that, but I need to multiply all. When I'm multiplying my network, I need to multiply my digital foot. I have to multiply my team size. I have to multiply my component procurement, warehousing, and logistics infrastructure. Finally, then comes the demand generation control in terms of how much I am able to generate or cater to the market share from my competitors. In terms of valuation, today we are looking at a valuation of anywhere between 50 to 60 crores for this first fundraise of say 3 to 5 crores that we want to raise. We will be subsequently raising money every year, stage by stage, so that our expansion of 3,000, 10,000, and 25,000 vehicles to happen. So we are looking at raising another close to from now, say $500,000 to up to $5 million in next 3 years period. Whether it could be complete equity or it could be a mix of equity and debt. That is another point. We are also targeting that by FY 29-30, we should be ready to get into an IPO, whether it is an SME IPO or a main board IPO. Now, to qualify for an IPO, you need to be at least 3 years profitable. Fortunately, we are last 4 years profitable. We'll maintain this profitability for next 3 years. We want to have a profit after tax of at least 3.5 to 5 crores by FY 30. If I had to do 3.5 to 5 crores PAT at FY 29-30, that means my top line has to be beyond 110 or 120 crores. If I do that kind of a revenue, if I do a 15 to 17% EBITDA, then only my PAT will be 3.5 to 5 crores. And if I am able to do a 3.5 to 5 crores PAT, then I think my valuation in the IPO stage should be anywhere between 300 crores to 500 crores.
Got it. And then one last question from our side is that, after this 28 years of work experience in the two-wheeler segment, automotive industry, what made you start this business?
I see. I know this market. I have been in this place since 1907, when the market was very small. I've seen the changes in market dynamics when foreign companies were allowed in India in early 2000, where all these Japanese came and set up their own infrastructure. So I'm somebody who knows in and out of this market. uh, So when we used to work in corporate, we had to plan 4 years, 5 years in advance what kind of products need to be launched, what kind of potential is available, what kind of new markets need to be penetrated, and what kind of differentiation we have to do if we have to win all the competition. Because when I was working with Suzuki, then our thoughts was, how do we compete with the Honda, how do we TVS, and what they are going to do 4 years from now, and what we need to do to be better than them. So when we used to do all those kind of planning, then that's when I realized that in future, looking at the condition that we have in terms of potential of people in India, in terms of consumption, in terms of the state of public transport. So I'm a very strong believer that even after 15 years from now, two-wheeler will still be a growing industry, because there is no other option from a consumer perspective to travel from point A to point B. That means the public infrastructure,
Right.
even 15 years from now, will not be good enough for the two-wheeler is a necessity in India, even for next 10 years, 15 years. In that, the EV contribution has to increase, because whether it is pollution, whether it is your fuel cost, whether it is your operating cost, whether it is the ease of driving a vehicle. So when you add all these benefits to the size of potential that is available for next 10 to 15 years, I think EV is the right space. Lastly, if I had to start a company to manufacture non-EV vehicles, ICE vehicles, the capex would have been extremely higher, because their technology is engine. And to engine contributes 35 to 40% cost of the non-EV vehicle. And to build that engine requires a huge amount of investment. And then you have to compete with legacy brands. But whereas EV does, legacy brands are not very aggressive. just now they have started deploying their money there. So I think this is an opportunity where for any startup or any person to come out and set up their own.
Thank you so much, Anand, for joining us and sharing all these insights. And the next steps will be like, we'll be floating an expression of interest form, and we will be, kind of taking a suitable time slot from you, and we'll be connecting all these people
Sure.
with you. And that is where we take it up from here. Thank you so much. Must say that whenever I meet a bootstrap founder, I love it. The reason is that that is what is the need of the day, is to build in profitable businesses, and somebody like you who comes with over 28 years of experience do understand the intricacies of business. And also thank Manjula, for kind of bringing in Anand on this platform. Thanks so
Thank you,
much,
Vishnu.
Anand.
Bye.